One of the harshest or the sad reality when it comes to trading is this. Most of the traders who blow one account eventually blow other account also, another account also, another account also. On Tuesday, on Nifty expiry, you make that account zero, and keeping that in mind, revenge trading, and on Wednesday or Thursday on Sensex expiry, another account also to zero, and then the next Nifty expiry, and it just keep repeating. And most traders destroy multiple accounts before they finally realize that the real problem is never, ever the market. It was actually the way they manage the risk. So the biggest misconception in trading is believing that your account blowups happen because bad strategies or bad luck. But what is the reality? The reality is that usually happen because the traders never identify the underlying behavioral pattern or your behavioral issue or your psychological issue or the root cause behind this that eventually end up first blow up, and then it will happen repeatedly. So instead what I've seen is that the traders, they blow up their account, they treat it as an isolated mistake, and then they come with a new account and fill the account with some fresh amount and promise themselves that you will be more disciplined. And what happens on the next day, next expiry, they repeat exactly the same behavior. The fear will come, the FOMO will come, the greed will come, and eventually end up losing that account also. So the goal today is basically to understand one simple rule that can make this account destruction structurally impossible. So it may be slightly difficult also to digest it, but if you follow it, one thing I can guarantee is that you will never blow up your account, right? So let's try to understand the real cause of account blowups. Now, whatever I'm going to discuss, you may tell that eventually when it comes to options, it's very difficult, especially as option buyer. These risk reward and the risk rule that I'm talking about, it may be difficult to implement, but you just start following this, right? Then eventually you will understand how your trading setup will change. See, every trading system experience losing trades, definitely, because it's a game of probability, because losses are definitely part of trading. But the real problem begins when the trader actually stop treating losses as a normal business expenses. Instead, you take it personally. Never ever take the loss personally. Have you seen me trading, whether it is in the live session or in analysis also? I never take any single loss personally because I am a businessman and I know losses are part of the business. That's my expense for running that business. A single loss may be creating frustration, but that frustration, what happens to you if you're an amateur trader is basically that is creating some kind of urgency. So that urgency, which is creating the desire to recover that loss immediately. But for me, it never happened. This loss is completely an isolated and independent event. So I'm looking for probabilities. There will be losses, there will be profits, and the losses are the cost of my business because it have to go on. Right? That's how I take it. That's how I want you also to take it. So if you have that frustration, and that frustration may lead to urgency, that urgency may lead to some kind of fast recovery process and the thoughts and revenge trading and all those. So once that emotional shift happens, then you begin abandoning all your trading rules and start taking trades randomly. So see, the sequence is very similar for most of the traders, right? At least if one thing is similar to all of you, the losing traders, this is that sequence. There will be a normal losing trade will come. That's a very normal. You might have taken a very good entry, but it took the loss. Another losing trade may come again because it's about probability. So sometimes it can come. So now the trader, your mind start feeling behind. And then what you do is to recover that, you increase the position size and you widen your stop loss. So think about it. You have done two things against your rule. You increased your position size and you widened your stop loss. And most importantly, the third entry may be a desperate entry rather than something which is suggested by the system. So on a desperate entry, you are increasing your position size and your stop loss is also widened where you are not having any clarity on that entry, right? And the trades that you are taking completely out of your trading plan. And then another loss occur. This loss will be bigger than the first two losses also. So again, you increase the risk, and within a short period of time itself, what actually started as a manageable drawdown or a small loss, that becomes a catastrophic loss. The market did not destroy your account here. Market just went as it normally. Market don't even know that you exist in this world. The escalation of risk that you have taken. You have widened your stop loss, you have taken a trade out of your trading plan, and you have increased your position size with the desperation to cover the previous loss, which was part of your system. And then eventually you end up blowing your account. So, see, one of the biggest psychological mistake in trading is believing that every loss must immediately be covered. There is nothing like that. That if you have that mindset, that actually create pressure to prove that the previous trade was wrong, rather than accepting that losses are normal part of the probability. There is nothing like that. There is no wrong. There is no such right in this. There is all about probability. So once recovery becomes the objective instead of execution, then what happens? Traders begin making irrational decision. So if you are thinking irrationally, then your loss is already started there. See, many traders, they believe the solution is simply becoming more disciplined. And that sounds reasonable also, but that is not complete. It is incomplete, I would say. Discipline is strongest when emotions are low. Unfortunately, the greatest mistake happen when emotions are the highest, right? The stress, so the frustration, and the fatigue that reduce discipline. And therefore, relying only on willpower is simply unreliable. So, what you need is, instead of depending entirely on discipline, you as a trader, you should create a trading structure that make destructive behavior difficult or impossible. So we are going to build a structure which makes that kind of destructive behavior or destroying your account as nearly going to be impossible. So see, the professional traders, they focus less on resisting temptation and more on removing temptation altogether. So the objective is to create an environment where breaking risk rules that becomes extremely difficult. So the good trading is built on system and not on emotion. So we are not going to discuss about emotion. I'm going to discuss about the system. So the simple foundation, the foundation of the entire framework is, I know it is going to be, see, for low capital people, it is very, very difficult to implement. Never risk more than 1% of your trading capital in a single trade. I know if your capital is 1 lakh and I'm telling 1%, it's just 1,000 rupee, but still you will have to follow that. Then you reduce your position sizing. You trade two lots or one lot, right? One lot of Nifty 65 quantity, and then you have a flexibility of 15 points stop loss. So 15 points, that is what you can afford to do, right? If you want to follow this rule, if you don't want to destroy your account, if you want to stay in the market for 6 months or 1 year. See, my simple rule is, if I am starting again as a beginner, if I want to do everything from the beginning, my only objective is to stay in the market for 1 year. Then market will reward me. How can I stay in the market for 1 year? This rule you need to follow. Just 1% risk, no exception, no adjustment, no just this one case, no, nothing like that. Every trade carries same maximum risk of just 1%. Your capital is 1 lakh, your risk is just 1,000 rupee. Now this capital is reduced to 90,000, your risk is going to be 900 rupee. So that is the most important foundational rule. Why? Because see, at first glance, you may see that risking only 1% may be very conservative because options move just like this, and I'm trading options. But if I'm trading in the stocks, it's very much possible, very much okay, very much comfortable. But still, even if you want to be a successful option trader, you will have to start practicing it. How can I do that? I can reduce the lot size. Yes, the point wise move will be faster and more, so reduce the lot size, right? And many traders believe it's actually slowing the account growth. Let the account be there for some time, then we think about the growth. But what is the purpose? The purpose of this rule is not a rapid account growth. The purpose, I told you very clearly, we are not going to destroy the account. What actually happening? You are destroying your account on a Tuesday, and then again on a Thursday, and then again on a Tuesday. So the purpose here is long-term survival. And let me tell you, if you survive in the market for 6 months, you will definitely be rewarded. So I'm just giving you the rules so that you'll survive in the market for 6 months. So if only 1% is what you are risking per trade, an extraordinary number of conservative losing trades would be required if you need to destroy an account, right? 100 such losing trades or more than that is required in a streak. That is never possible. And for any trading system with even a modest statistical edge, such sequence become highly impossible, improbable. So the basis that the rule is shifting the focus from maximizing return to protecting capital. And that is your ultimate goal as a trader. Protect your capital. Then you can run the business forever, right? It's not about profit. Profits will come automatically, naturally. So now again, we need to eliminate the need for speed. This is again one of the biggest reason why traders fail. It is basically the desire to grow account quickly. See, the pressure to make money fast. When that happens, what happens ultimately when it comes to trading? You'll take emotional trading, irrational trading, not trading, ignoring your trading plans, or you take revenge trading or oversized position or widening the stop loss. So when you're keeping this 1% rule, that remove that urgency. You cannot have oversized position. You will, in fact, reduce the size. You can't take emotional trading, right? You can't take irrational trading. You need to go with the trading plans. So once the need to quickly grow account disappear, then the decision making becomes much easier and much calmer than the survivorship bias. See, many traders they compare themselves to individuals who took excessive risk and achieved spectacular returns. Now, what they rarely see are the far greater number of traders who followed the same approach and lost everything. Very few, very minority might have become successful after taking such risk, but a majority always failed, and that's what known as the survivorship bias. See, learning from that rare survivor, you are ignoring many failures. That is basically creating an unrealistic expectation, and that is creating a dangerous behavior, especially in trading. And the greatest benefit of risking only 1% is your psychology. See, when the loss is small, you don't have a fear. Fear will decrease. It is manageable. I can see, I can be relaxed. If I'm risking 30, 35%, 10, 20% in a trade, then I'm finished. My pressure will increase. The fear will increase. Emotional pressure here will decrease if it is 1%. There, if I'm taking more risk, it will increase for the next trade. The desire to recover immediately, that won't be there if I have lost only 1%. The decision making again becomes more objective and more rational. That's what I want, right? A small loss that becomes simply another business expense rather than you're taking it as a personal failure or you're taking something which is very personal. And when this happens, that dramatically reduce your revenge trading. You start taking rational decision also. Now, what I want you to do is, you have to have a pre-commitment system. See, knowing the rule is not enough. The trading environment should make that breaking the rule difficult. So before you begin your trade, you calculate 1% of the current account balance, right? That's like 1 lakh is the capital, 1,000. That becomes the maximum allowable loss for any single trade and configure your position sizing accordingly. So if I'm taking a stop loss of, let's say, 8 points, then Nifty, I can afford to go for two lots. I know the trade, I got the trade. Now, what I need to look at is the stop loss points, 8 points, then two lots. But if I need to take a trade where the stop loss is 15 points, then I take only one lot because my loss is fixed. That should be 1,000. So you have to configure your position sizing accordingly. And some traders may also use practical reminders like position size limits within the trading platform itself or risk calculator before every trade. All these, if you want, you can do. But see, I can do everything mentally. I'm that strong. If you are that strong, then you can do it. You can have a checklist. Otherwise, sticky notes reminding them of that 1% rule. Whatever it is, the objective is to reduce reliance on memory and emotions. Do this, right? Now, see, the roads on mountain highways have guardrails. Have you noticed that? Not because the drivers intend to crash. Why it is there? It is because unexpected situation can occur. That is why that guardrail is always there on the mountain roads. So similarly, what we need is risk management rules exist basically to protect the traders during that emotional moments rather than during the calm conditions. So you need to have this proper risk management rules. And then I'll give you a cool down protocol. See, managing losses does not end with position sizing alone. Right? Behavior after a losing trade is equally important. I lost a trade immediately. I'm jumping onto the other with the same position sizing. Then it is equivalent to continuing with the previous trade itself. Right? So what we need is a structured cooling off period that helps to prevent emotional decision making. So the framework here is very simple. After one losing trade, you have to wait at least 30 minutes before taking another trade. Otherwise, you eventually end up taking the same trade again. So you took a stop loss. Now you'll start seeing that trade again coming in my favor. It is now trading above my stop loss level. So I start thinking about, I might have taken a wrong stop loss and I should re-enter again. That again will go and hit a stop loss. Then you will widen the stop loss. That should not happen. So give a 30-minute break after a losing trade. After two consecutive losing trade, you will have to stop trading until the next session, which means in morning session, you divide into two sessions, morning and afternoon, 9 to 12 and 12 to 3. So if you have taken two losses in the morning session, then like 9:30 you have taken a trade loss, and then 10 o'clock you have taken a straight loss, then you trade in the afternoon session. That's it, not in the morning session, right? Now, if three consecutive losses happens, then don't trade for the entire day. End your trading for the next day. That means first two trades you have taken. Yes, that means first two trades you have taken. Uh, yeah, that is loss. That's in the first session. Then the third trade you'll be taking. If it is in a loss, you'll again have to close the system. Now, why this will work is, see, every loss that creates some degree of emotional activation, right? Even small losses that will affect your judgment. Yes, small losses can reduce that, fear and that pressure, but still, small losses also will affect your judgment, right? Because you want to win in all the cases. See, when emotion increase, the pattern recognition deteriorates. You may find a pattern like cup and handle or head and shoulder or EMA support or pivot support, whatever. But that recognition may not be as good as normally when you are trading without pressure. And the objectivity also will come down. You start taking irrational decisions because the desire to recover that is getting intensified. So taking another trade during this emotional state that significantly increase the probability of additional mistake. So when you have the cooling period, that interrupt that cycle before it actually escalates. So there will be always another trade. That is what you need to think. One common concern is missing the next opportunity, right? See, let me tell you, market create opportunities every day, every hour. Missing one setup, it's okay. It's far less damaging than allowing an emotional trade that destroy your account. It's okay to miss that because you can come back and you can take the next trade. Patience always protect the capital. Once you have the capital, you can do the business. Once you do the business, you'll be able to do something better, right? So capital create future opportunities. We need the capital protection. That's more important. Now we have discussed about daily. Per trade ceiling 1%, daily ceiling also you keep max three trade loss. That means 3%. So in addition to this individual trades, daily losses also need to be limited. Otherwise, you'll take n number of trades. That's why I told you you will limit with two trades. That means per session loss maximum is 2%. Per day's trade loss maximum need to be 3%. So once 3% or three trades is hitting the stop loss means stop trading for the day. No exceptions, and that is actually a circuit breaker before the emotional behavior takes control of your trades. I hope this is very clear. Suppose you have a 10 lakh account. What is 1%? 10,000. That is your first loss, right? In the same session, again, one more loss, 20,000. You stop for the session, and then comes afternoon. You take one more trade. If that is also loss, stop for the day. That means 30,000 is your max loss per day. It's very clear. There is no exceptions. There is no change, right? See, most of the traders, they only analyze profits and losses. Very few will analyze their behavior. The important questions are, see, whether was this trade, you know, taken based on my setup? Did I follow the trading plan? What emotion existed before the entry? Why was the rule broken if the rule is broken? So you need to track all these patterns that will allow you to understand the mistake, and you can avoid the recurring mistake also, because the recurring mistake will be visible if you analyze this. So once this behavioral mistakes becomes visible, right, then it is very easy for you to eliminate that. So what you need to do is, what I told us, just follow these four rules. First is 1% risk on every trade, and then create a pre-commitment system that prevent excessive position sizing. You need to have a structure. Follow the structured cool down protocol after loss. Means after first loss, don't trade for 30 seconds, 30 minutes. Second trade should come only after 30 minutes. Any trade that is missing during that time, it's absolutely okay. I told you, missing a trade is much, much better than taking an emotional trade and that eventually leading to loss. Okay, so per session, two losses. If two losses happens consecutively in a session, stop for the session. Third trade you take in the second session. And if you're losing third consecutive trade, then stop for the day. Simple rule. Max loss per day is 3%. Max loss per trade is 1%. So if you see, you will see, if you follow this framework, you need to consistently follow this. That change more than just your trading performance. It change your trading identity also. Eventually, the trader no longer follows the rules because someone suggested them. The trader is actually following them because discipline, risk management become part of who they are. And at that stage, protecting capital, that becomes automatic. It have to happen. It's structured, right? It is necessity. And the objective is not to avoid losing trade. The losses are always exist. We are embracing the losses with at most happiness, right? And the objective is basically to ensure that no single trade or even a series of trades has the power to destroy your trading account. So consistency comes from surviving long enough for that statistical edge which has to play out because it's about probability. So guys, let me tell you, successful trading is not built on predicting every market movement. It is built on controlling what can actually be controlled. That include what you can control: your position size, your risk management, your emotional behavior, your trading discipline, your structured decision making. So the single most important principle is very simple: never risk more than 1% of your account on a single trade and not more than 3% on a day. So support that rule with a pre-committed system, a cooling off protocol, a daily risk ceiling also. So when these structures, if you follow that in a non-negotiable manner, no exception, you won't blow up your account. It is extremely unlikely, it is impossible. Emotions always remain under control. And you as a trader gains the most valuable asset in the market: time. You get time to learn, you get time to improve, you allow that genuine trading edge to produce consistent long-term result also. And most importantly, you stay there in the market for long time, and that's what ultimately going to reward you, right? So if you would like to join us for the mentoring sessions in the live market to demonstrate all these, to learn all these, talk to our team, join the session. See you there.